everyone. This is Henry Gamble with SimplerOptions.com, and in today's free video, I just wanted to touch a little bit on the topic of, as the subject might lead to, what to do with indecision. So, as today's session opened up, and we can drop down into something like a 5-minute chart, and we look at where we were trading. We had a fair gap up. It wasn't anything crazy. It was about 9 or 10 S&P points, and inside of that, we knew that the trend reading and a couple other things that we have been discussing in the chat room were signals that may have provided this little bit of a bounce. I do think it's very important to recognize that in bearish markets, gap ups get sold. In a bullish market, gap lower gets, purchased. So anyway, basically to summarize my thoughts here, I'm just saying we had a nice gap up. The market was immediately sold. If you look at SPX, which is always a great measure of the cash markets, in the end we only closed up about 2 points. We had a much nicer gap open. I step back and look at this from the perspective of there's going to take a lot to change my perspective of this market. First and foremost, we're going to need a daily close of 1892. Until that happens, I think we have lower prices in store. Now, this week, obviously, we have employment data that is due out at the end of the week. We have several other Fed big names from the Fed that are going to be speaking. And I think it's important to recognize that there could be some indecision around that. So you literally approach this market from one of two places. You are either outright bearish, or you approach the market from somewhat of a neutral stance. If you're approaching the markets from more of a neutral stance, that's where I step over to ideas like what I shared today in the chat room with Google. Now, will this trade be guaranteed to make you a ton of money? Of course not. There is no such thing in the markets. But all you can do is try to put the probabilities in your favor and try to put, the technical levels in your favor. We have seen so much how Google has done a really good job of consolidating near the 630 level. And I'm reminded of the iron fly that we traded, several weeks back right here in this zone, and recognizing that as a fresh potential. So if we come up and we take a look at our option chain, the only question you are asking yourself here is what is the expected move for the week? So when we take a look at Google, and you think about how long you're expecting this duration, or how long are you looking to be in a trade, well, in a front, kind of in your face, basing off what we're seeing this week, I think I wouldn't want to go out much further than the strikes that are expiring this Friday. In light of that, what I would do is look at what was our closing price. So we closed here on Google at 622. What I would look at is say, okay, we've got a $15 expected move based off 622. That would give me about 600 as a psychological support. Granted, that's $22 away, but that's a rough level. If we come in and do something like sell an iron, and this is a little different. This is, I spoke about this to some degree in last night's free video with similar concepts in Facebook and Tesla. This is a general idea, but it's structured slightly differently. So what I'm going to look at doing is selling this straddle. Selling the straddle to start basically our non-directional biased exposure. That's going to take in about a $15 credit. Based off of that, and it's a little tough to show with such a small screen real estate, but then I want to come in, and if you'll hold control in Thinkorswim, you'll be able to buy a straddle. And what this does is allows you to be short the at-the-money straddle while buying a strangle further out. And I think this is some of the best strategies to look at here. So if I'm selling the 622 call, and generally I prefer doing these around round strikes, but there's nothing wrong with doing them here. We step up about $20. That's going to land us at 640, and then to the downside, I would play the 600s. This is where you can get a really good credit, play a neutral market, and if everything explodes and it does end up being a big, down day or up day or whatever it may be, your risk is still very well defined. So part of the reasons why I've always had my iron flies as my backup strategy is for that indecision. And I think it's a great way to look at markets. In that light, Don is going to be doing a class on ratioed butterflies. And if that concept makes sense to you and you're seeing what we're looking at with that type of a trade, this is the way that Don enhances those types of strategies. So the things that I've been discussing and most of what I trade are very balanced and even butterflies. But if you want to take that leverage and max it out, and really try to get the most out of that body and really work the decay inside of, juiced up implied volatility, I think this is the way to do it. So Don's going to be going through this on next Wednesday. That's going to be the 30th. It's a 2-hour class, and if you've been in any of Don's previous classes, they speak for themselves. So anyway, I think it's a very reasonable price. I think you're going to learn a wealth of information from it, and if that's something you're interested in relation to what I've discussed in Google, I hope to see you guys there. Have a great night, and I will see you at the next free video.